Hey, good morning, everyone, and welcome to Market Chat. I appreciate you letting me do this by recording instead of live. It helps out a lot. But I'm going to jump right in here because the market is live. It's 9:15 this morning on January 4th. As we record this. So let's see how this works and how this plays out. So yesterday, if you're watching your emails and your texts, we came out and recommended, hey, hold your short corn positions, even though we got chopped up a little bit at the end of the week last week. I think that was just end of year dynamics, and you can see exactly what we did here. We traded back to the top of this price channel where we reversed. This was also the 61.8% retracement level of this move from the top here all the way down to here. You can see this 61.8% retracement line, which would be common for a counter trend rally to stall out at. It also held this 692 level that we talked about before, which is where the move really accelerated lower from 692 down to 635. So it reversed at a lot of different inflection points and is currently accelerating lower. So I think if we get back outside the bottom of this base channel, and obviously you got a lot of chart support right here at 660, 653. If we're able to slice through that and get down to the bottom of here, I think we're headed to new lows here in corn. And remember, corn is being driven by supply and demand fundamentals. It's the dollar and oil. We're not reacting to those. We're reacting to the impact that lower oil and higher dollar has on supply and demand, right? Just because oil's down doesn't mean corn will go down, and just because it's up doesn't mean that corn will go up. The market is trying to discount future supply and demand issues. So if prices are going to go up, you have to either shrink supply or increase demand from where that is. And you have to ask, where is that going to come from? And the answer today is unknown. We don't know where supply shortages are going to come from, and we don't know where demand increase is going to come from. Now, the opposite is actually more accurate. We know where demand decreases will come from, and we know where supply increases will come from as well. So if our market is continuing to sell off because of less driving, higher ethanol stocks, lower exports, all those kinds of things, then that's lower demand. So that grows our balance sheet, which is why we start to sell off. So ultimately, always price is reflective of fundamentals, always, but technically, those tend to lead the fundamentals. So this move here was counter trend. It developed in 3 waves. It reversed at significant levels, and now is attacking the lower levels here. So if we break lower from here, I think we have a lot longer to go. So I would absolutely recommend holding short positions here. And remember, a lot of times it's harder to stay in a position than it is to exit one, especially when that position is profitable. So at this point in time, I think you got to look lower in corn at a challenge of at least 635, probably lower, but our first hurdle is the 660, 650 level, okay? Now let's look at soybeans. Soybeans, a lot the same as corn, except they're not quite as mature yet in their down move. And remember, the supply and demand fundamentals are characteristics are the same for beans, right? In order to move higher, you have to shrink supply or grow demand. And the market has been getting a little bit of both of those. The Argentina headlines are very strong, and that is both bearish supply and bullish demand because they crush so much. So if they don't have the beans to crush and turn into soy meal, then buyers have to come back to us in order to procure that supply, which is why we really did accelerate higher here. But weighing against that, right, is the size of the crop in South America, in Brazil. Because if that crop is as big as we think it is, and the weather's good, so it's getting bigger as the Argentinian crop is getting smaller, then those fundamentals are overwhelming and will prove to be ample supply. So we don't know yet which it is, but what we do know is that this day yesterday was a nasty day. And if we are able to break through this low and challenge the bottom side of this trend line and this little chart resistance here, you know, see you later. I would say the line in the sand for beans is 1460 on March, and or between 1450 and 1460, which is the lower, which is this uptrend line and this chart resistance right here. If we're able to trade lower, then look out below. Our targets are much lower on beans. But so if you're unhedged here, I would go ahead and hedge them. I don't think there's any reason not to be hedged, because hey, if we reverse here and we come back up to 1530, we can always re-own them. There's not a whole lot of barriers to us to re-owning, and if the fundamentals warrant it, then we will. But for today, technically, yesterday's low, this area and down here are, you know, those three things break, and I don't know what's going to keep this market up. I mean, it's going to go fast if it does. So I recommend hedges be in place on beans. I don't think anybody's going to regret that. And if we do, hey, you know, the worst case scenario is we're selling March or November beans $1 higher than at any point in history on January 4th. So I don't think you should overthink that at all, because this chart pattern can turn negative really fast, and these lows down here are absolutely in jeopardy if all this stuff gives way. So hedges in place, and if we trade back above 1428 or 1436, we'll talk about re-owning and putting a position back on there. So stay tuned to your texts and emails, and we'll keep you up to date on how those markets are trading and what we think needs to happen here. Let's jump back to corn here for a second, because I forgot to show you December. December corn is acting the same as March, with one exception, and that is that it's actually already weaker because it's given up this area of congestion that we've been concerned about. You know, this would equate to 660, 653 is that low right there on March, and we're trading all the way back below it. The only difference is in March we're trading at the bottom of this trend line, right? Go back to that. So here we're trading at the bottom of this hedge line, and let's make sure we're talking the same hedge lines. Yes, we are. We're talking the same hedge lines. So this December's got a little bit more work to do, but if March does break the same level, I would look for it to accelerate lower faster than December does. Okay, now over to wheat. Yesterday we put out and we said, hey, we think wheat's got an opportunity, or for the last several weeks we've been saying wheat has an opportunity to trade up into this 9 to 950 range. I don't think we're going to get that based on the weakness that we saw yesterday and today. And if you look, you know, there's this trend line right through here that we traded up to and reversed from, and we are now trading below these three lows right here, which is a bearish signal. And I think that puts in play this lower base channel down here at 770, possibly even lower depending on how long it takes for it to get to. So I think wheat has got a new leg lower here. I would expect this to last a couple of weeks, and then we'll look to re-own depending on what corn's doing and where beans are at. But for now, I think the move is lower in wheat, and I don't see any reason to be overly optimistic about a move back higher. You know, this is being driven by Russia just dumping wheat all over on the world market, right? And it's also being driven by corn being out of the market globally. So if those demand fundamentals don't improve for us, then I think you got to look lower yet still. And the supply side, I know our crop isn't great. I know we have a lot of drought, but the market knows that too. And the reality is that the only place that's really bad is Kansas. The rest of the wheat states are okay and seem to be improving somewhat. So that's why we're getting lots of pressure on wheat. I would go ahead and hold those short positions. Again, you know, yesterday we said 905 was the stop in March wheat. That's clear up here. I still think that's the best stop to have. If you wanted a tighter one because you didn't like that risk, then I would put it at today's high of which is 872. and that's where a good stop could be right at today's high. That would force it to come back up into these three rows and or these three lows, and would put us back into a a doji formation or an outright reversal pattern. So I think that's a nice spec setup right there, and something that you should consider taking. Okay, that is 10 minutes. I hope this video is helpful. Again, I'm sorry it's a little bit brief, but the markets are pretty busy, and we got lots of activity happening here in the office. If you have questions, please call us. We're happy to talk through anything that you need. Remember, there is risk trading futures and options, and you should only do so in light of your own financial condition. We will talk to you later on. Have a great day.